You are listening to the Mark Guzman Podcast Experience. When is the best time to get a mortgage? That answer depends on a variety of factors, most of which tie into the stock market in one way or another. Recently, the stock market experienced its biggest drop in over 2 years, dropping over 1,000 points amid worries of a rising federal interest rate, corrections, and other uncertain factors. Our guest today on Real Realtors is Harold Bauer, who does mortgage consulting with Caliber Home Loans out of Walnut Creek. Today, we pick his brain to get a little insight on how the activity on Wall Street impacts your home, mortgage, and refinancing options. So, Harold, I want to thank you for being on the podcast here. And you're with Caliber Home Loans.
Caliber Home Loans.
And how long have you been in the business now?
I've been in the business for a long time. I got my real estate license in 1991. Over on the peninsula, working for Palo Alto, a place called Palo Alto Funding. Interestingly enough, now that man that owned that company, his name is Chris Larson, and he is the founder of Ripple, and he's one of the wealthiest people in the world. But I got my start in 1991, and I've been at it ever since. I opened my own company in about 1999. I was a broker for about 10 years until things got bad.
Okay. And then when did you join Caliber?
I'm a recent addition to Caliber. I started in December of 2017. So one of my passions is helping, Vicky and I, our passion is to help people get into homes. And so we kind of found a cultural match with Caliber. Caliber, the people that work for Caliber, and Caliber itself, that's their mission, is to get people into homes.
So what eventually got you into mortgage lending?
It's one of those interesting things where I fell into it. I certainly didn't grow up thinking I was going to get into this. I started my first job in the business world. I was working for a consumer finance company, which is a tough job to have, at least back in those days, in the early 80s. But what I discovered that I enjoyed meeting with people and providing solutions to their financial problems. And that helped me then eventually. It was a natural fit then to take the next step, which was to get into real estate loans. And I would do the same thing for people in real estate. Is I would look for some type of solution for them. If they owned a home, I would look for a solution to refinance their property. And then, of course, I would always look for people who are trying to get into homes.
So a new client contacts you. They want to purchase a home. What's the process? Well, let me ask this. Do many of the clients coming into you already have a real estate agent, or are they being referred to you by a real estate agent?
It's definitely a combination. So we always, as someone in my business, I look to form relationships with realtors and, of course, get referrals from them. But I also do a lot of my own work. We do first-time homebuyer seminars. We do, there's a lot of activity to try to generate those clients to come to us directly. And so at this point, I'd say maybe it's probably 50-50 where we get our own clients, our client referrals through our own networking and marketing. And then also the other half would be coming from our referral partners, realtors.
How do those seminars work for you?
They're tough. So it's, we love giving them because frankly, I think I'm a teacher at heart. I've coached basketball for many years. I love teaching. But the hard thing is always getting people to show up. So, we provide the forum and we do the best we can. We certainly try to market them and give people enough warning and, advanced, not warning, but advance of the seminar and,
the marketing of it and pitching it.
Yeah, and we just so we have one coming up in a couple of weeks on the 21st, and we already have a nice response, and so we'll keep our fingers crossed.
I've done a few seminars myself, and I at my last company we had a foreclosure sales team, and this was back 2007 to 2011, and around 2008 or 9 we decided, well, why don't we, since we have these listings, let's try to focus on getting some home buyers. And so we held a home buyer seminar. We had about 50 people, and it was pretty good, but it's so difficult to get people in because then I held a second one, and I'm thinking, okay, well, the first one I had 50 people. Second one, I've got to have something similar. I had literally 0, and I had probably 20, 25 people confirm attendance, and 0 showed up.
Yeah.
So those are really tough to put on.
Yeah. Well, we always try to entice them with good food. Yeah, it's tough. It's tough. You put it out there, you do the best you can, and in the end of the day, that's really what more can you do?
Yeah.
You know?
So in lending with Caliber Home Loans, what are some of the main criteria you're looking for in a buyer?
Well, let's see. So the main criteria is for someone to get a loan, or for just to
to get a loan.
So there's a number of different criteria. So there's, of course, there's credit. Credit's always an issue, and also character, which is the ability to repay a loan. And so those are always under consideration. And so after the financial crash, it became very important for any client. As a matter of fact, the government has put very strong restrictions on this, that the client must be able to have the ability to repay a loan. And I'm sure if you've been in the business for a long time, you may remember some of those old loans where they didn't have to prove their income. Well, now they do. And so the ability to repay a loan is extremely important. Now, credit, with Caliber, we have a range of loans where we have the best of the best. If you have great credit and you make a lot of money, we'll have a great rate for you. And then there's also programs available for people who perhaps had a credit event in their lives that maybe made their credit score a little bit lower. And it happens to good people. And so we have programs for them as well. And so, the best thing to do is for a prospective, someone who's even remotely interested, is have them contact their real estate professional, their lending professional, and get pre-approved. And we do that for as many people as we possibly can. And so what we do is we gather the information, we check your credit, we check your employment, how much money you make, and it can then therefore determine how much of a house that you're going to qualify for. And that's the most important thing. And most realtors, when they see a prospective buyer, they want to know, are you pre-approved? That's critical. And before most realtors want to even see someone, they want to make sure that they're pre-approved. So I would say that's the most important step, is to make sure that you're pre-approved. And we at Caliber have a process that the process is fully underwritten by an underwriter. So it's an approved. It's an approval on a property that's to be determined. And the benefit to that is that the buyer, without even having knowing which house they're going to buy, knows that they're qualified for the loan. And so we have that option at Caliber, and it's really, really important to know that ahead of time.
When I have listings, I'll talk to the buyer agent, I'll talk to the buyer's lender, and ask them various questions and find out if they're really approved, or is this just because I've had experiences where some loan officers have literally given the buyer a Word document and said, hey, go ahead, edit the document, just submit it, and then we'll figure it out later, right? And so I love it when a lender and the loan officer will actually get the buyer approved, because it also saves everyone a lot of time and the headache from the buyer, because nothing's worse than thinking you're approved for, let's say, $500,000, and then you go to make an offer, you get into a transaction, and then find out you can only qualify for $400,000 and the deal falls apart. Yeah. And even worse when your deposit's at risk.
Well, a huge mistake that lenders make is they will offer just something called a desk-type underwriting approval, which is just the automated approval that Fannie Mae or Freddie Mac give. It's computer generated. You punch in numbers and it will say, yes, this is a loan, or no, it's not a loan. But what it doesn't consider the overtime income. And if it just considers that one number, well, when a live underwriter looks at that, they may determine that, well, even though the person's making this much in overtime, there's no history of that, and therefore they can't use that. And so that's the huge difference between having an underwriting approval and just a generic desktop underwriting approval is, you need to have that live person check it out and make sure that this is going to be good and you're good to go. Because you're absolutely right. There's nothing worse than at the last moment having a loan decline, and it's not good for anybody at that point. Not good for the realtors, not good for the lender, especially not good for the poor buyers.
So if the listener is a home seller or they're a listing agent, what should they ask for as far as documentation? From
An important thing is this a desk type underwriting approval, or is this an underwriting? Is this a regular underwritten approval? That's critical.
So ask for an underwritten approval because
Right.
that's stamped off by somebody.
Right, and so most approvals are either going to be DU or LP. Um, Fannie or those are the Fannie or Freddie approvals, and so I think a listing agent would be wise to know whether that's the type of approval I have, or if it's a full underwritten approval by a live underwriter, and again that's critical, and that's one of the great things that Caliber does is Caliber will absolutely give you, once you give us your information within a day you'll have a full approval.
Okay. You mentioned just about a minute ago that people interested in buying a property or getting a mortgage should just talk to their real estate agent or mortgage professional and see what they can qualify for. I deal with a lot of tenants, and many tenants have that goal in the future to convert from a tenant into a homeowner. Now, many of them, talking with them just over the last few years, they are hesitant to talk to a mortgage professional because they're worried their credit score may not be that good. So question number one is, what is the minimum credit score that people really need to qualify for a mortgage? And then number two, what can people do to help out their credit score, increase it a bit?
Well, those are great questions. So I believe with Caliber, the lowest credit score that we're going to use on an FHA loan is 580. Okay. And so if you're 580 or above, and oftentimes I find that it may even be difficult to be less than 580. Most people are not less than 580 unless there's a huge credit event that's recently happened.
I think the average is like 650, right?
Yeah. So, correct. So most people will have a greater than 580 credit score. And with a 580 credit score, you can typically get into an FHA loan, which is a government loan. But the important thing is to try to overcome that fear, simply because most mortgage professionals will be able to advise you on, well, this is what your credit score is now, but if you do these things, perhaps your credit score can increase. And there's just a number of things that they can do. If there's any derogatory events that have recently happened, then try to overcome that. There's many things that you can do. And so typically one of the easiest things to do is if your credit cards are at a high, the percentage to your credit card balance to what the limit is on your card. So typically to get the best credit scores, you want to be around the 30% range. So in other words, if your credit limit is $1,000, then you want to keep your balance around $300. And so by doing that, that will definitely raise your credit score. And those are really simple things to do. The important thing is to definitely reach out to your mortgage professional and have them offer some guidance on easy things that you can do to build that credit score up. But don't be afraid. I mean, there's really nothing to be afraid of because simply getting the information is powerful. And if your credit score is 550, well, then what do I need to do to get it within range to qualify for a loan? And we'll help you with that. That's what we do.
Yeah, and then it's something you can work on for 6 to 12 months and then get that fixed, turned around. And and you mentioned like a really good point with the balance to high limit for credit cards, because I've dealt with a few buyers that may have, let's say, 5 credit cards, and 2 of them, 3 are at zero balance, 2 of them are maxed out, but they simply transferred the balance of those 2 to the other 3 and spread it out, and they hit that 30% requirement, and all of a sudden, their credit score jumps up by, who knows, 20, 30, 50 points.
And oftentimes, that increase in credit score is the difference between interest rates. And so it could be the difference in whether you qualify for a loan, but also past qualifying for a loan, it could be the difference in a lower interest rate. So it's really critical that, listen, if your plan is to be in a home within a year, we'll start working on that now. Without a doubt, that can be a huge help.
Yeah, and I tell that to people all the time. Just because you have the credit score to qualify doesn't mean you should now go out and actually purchase. Work on your credit score, build it up, because it's a big difference. If you just look at the difference of what you pay over the life of a loan of just 1/8%, it's huge.
Huge amount. You're
Yeah,
absolutely right.
especially here in the Bay Area where the prices are so expensive, it even compounds even more.
And one of the interesting things that we find, so living in the Bay Area is definitely unique because the housing price is so expensive. Most people can't afford to get into a house, or so they think. And so then what they do is they'll compensate um, by buying an expensive car. So and I can't tell you the amount of times we've had to deal with that where we've had clients who are trying to get into a home and they have an $830 payment, and that will get you out of qualifying for a loan quicker than anything. And so if you're thinking of getting into a home, or maybe that's within your next 12 months, your plan, please hold off on buying that expensive car until after the transaction closes. Once the transaction closes, go buy your expensive car. But boy, that's one of the things that we've noticed, that there's huge high car payments, and that really does not help at all.
Yeah, I think the average car cost right now is about $35,000, a little bit higher here in the Bay Area. And that's just your average car. When you start including luxury purchases, you're now in $40s, $50s, $60,000. And yeah, that's a huge payment for someone to take on. And that's probably one of the most frustrating things, is a buyer that in the middle of a transaction will go out and buy a car thinking they've got the pre-approval, they got their offer accepted. Now it's simple, easy, we're going to close this in 30 days, no problem. They go out, buy a car a week later, and then here comes the credit review, and they don't qualify anymore.
Yeah, and it's painful. That's a really painful lesson for everyone involved. And so we always have that conversation once we start the process. Please don't make any huge purchases. Please pay your bills on time. Please don't change jobs. That's another one. Changing jobs, midstream could really impact whether you qualify for a home or not. So that's something to consider as well.
So let's talk about that, because there's a few rules when it comes to changing jobs. And I believe it's if you change jobs, but if you're in the same field, same industry, same position, I believe it doesn't count against you, correct?
Correct. You're going to be fine.
Now, if you change completely different jobs, what's the minimum amount of time before you qualify?
I think some lenders are going to say 2 years. So you need to be in that. Now there are some programs perhaps that are out there that can overcome that, but most industry standards are going to say 2 years.
And that's because they want to see job stability, and that goes back to the ability to repay back the loan.
Absolutely, the character. That's one of the C's, the 3 C's of lending. But yeah, absolutely.
Now, is there still a big issue with getting pre-approved when you're buying? And I know this was a big deal after the market crashed. I haven't heard much about it lately, but how it was is, if, let's say, I wanted to buy another home that was maybe within the same neighborhood, maybe within the same city, they would really scrutinize what I was purchasing. Am I upgrading? Am I downsizing? Or if it's something very similar to what I have now, they were really scared that I would buy it and then default on my current home. Is that still something that's discussed and something that's looked at?
It was much more common right after the crash because people were just walking away from their properties, but they wanted to, of course, get into a home before they did that. So
now people are happy prices are back up, right?
yeah, you bet. So I don't really see that happening too much now. I do know that a few years ago it definitely was an issue, but a lot less right now.
Yeah, I haven't heard many people talk about it, so I was just curious to see if you've dealt with it or heard it in your circles.
If you're here in the Bay Area, you are fortunate because of the last few years, the values of your home has increased. So every purchase transaction that we did within 2017, every single home, the value has increased on their properties. Every single one. It's been a good investment for everyone who bought in 2017.
Yeah. So let's talk about interest rates, because we were just briefly talking about the higher credit score, the better interest rate you get. But the interest rate fluctuates quite a bit. And I think for maybe the last, seems like 8 or 9 years, we've always heard the news and the media talking about interest rates are going to go up, interest rates are going to go up. And we've had record low interest rates. I mean, if you look at the 30 to 50 year history, I mean, these are ridiculous rates, even at where are we at now, 4.375. So So we're still at very low rates, but now there's that talk of, well, now it's really time for them to start climbing back up. How are interest rates? How are they generated? What determines, if it's a 4 or 5% rate?
Getting beyond my pay grade here. Okay. So historically, you're absolutely right. Historically, interest rates are extremely low. As an example, when I bought my first house in 1989, I got an FHA loan. It was 11% fixed. So whether you have a 4%, 4.25%, 4.5%, or even 5% rate, historically, it's fantastic. And so the thing that drives interest rate up the most is the fear of inflation. And so, typical economic indicators will indicate whether, and oftentimes it's just, things have been so low for so long, even just the hint of a fear of inflation will drive rates up. Or any type of certain instability will drive rates up. And, you may have noticed over the last few days, there's been just wild swings and on the stock market. And typically the interest rates are driven off the bond market, the 10-year bond. And typically they move inverse to the stock market. So if the stocks are doing well, people are pulling money out of the bonds and putting into the stock market, and therefore the interest rates go up. Over the last few days, that has not happened. It's been a little bit of it's more than a little bit. It's been an absolutely insane last couple of days with the stock market having, 1,000 point, 1,600 point fluctuations. And so it's been tough. It's been a tough few days. So what drives that is the fear of inflation. And so inflation has been kept in check for so long. And actually our Fed their main job is to make sure that we don't suffer from inflation. And they do a good job of that. But again, things have been so low for so long that any type of hint of inflation, and if you've noticed, the stock market has, with the exception of the last few days, has increased by 10,000 points over the last 12, 13 months. So naturally, with that happening, with jobs, with the economy improving, there is a fear of inflation, and that will drive interest rates up.
So I know a lot of people get confused. So thanks for that explanation, because a lot of people will hear the Fed is going to raise interest rates, and they think that's raising the mortgage interest rates, but they're talking about a completely different rate that they're increasing, right?
Yeah. The Fed is just in charge of raising extreme short-term rates, and so.
And I believe that's a bank overnight rate.
Yeah. So when the Fed raises rates, what it will affect much more is your home equity line of credit interest rate or your car interest rate. The 10-year bond is what drives our mortgage rates, and so. As the bond, I think, so what are we at today? We're at 2.78. So 2.78 on the 10-year bond is unbelievably low historically. Now, we reached a low last year of about 1.5, which is almost free money. So even with a bond yield of 2.78 and rates now probably 4 3/8, 4.5, it's still fantastic. But just a year ago, rates were a little bit lower. They were 3/4 of a point lower. So so of course there was anxiety over that. They're still really good, and still many people can qualify to buy a home, even with these rates.
So what's your opinion on the current Bay Area market? I mean, we have a huge shortage here. I mean, I want to get your opinion. What can be done to help fix this? Because, there's a lot of buyers out there that want to buy, and one of the biggest issues is they get outbid. I mean, I was representing a buyer that wanted to buy in Oakland, and we were placing offer after offer on property after property, and a lot of these properties were getting 40 to 50 offers. And so eventually they just said, okay, well, we can't buy in Oakland. Let's go outside, and eventually they bought a home that they love now, but, the competition is so tough out there.
Well, there's just a myriad of factors. People, it's just an extremely tough market. So there's no inventory, and there's a desire. And so when there's no inventory and there's a desire, it's going to, of course, increase property values. And so it's really tough. And so we've in the last month I've heard a number of experts speak, and one of them just last week, and she talked about how really the tech industry in San Francisco and in the Silicon Valley is really driving this, and the future is extremely bright. And so what that means is more people will be getting more tech jobs. They'll be making more money. Those people want to buy homes. They can't buy on the peninsula in San Francisco because there's nowhere left to buy. And so that just kind of spreads outward. And as it spreads outward, it affects Oakland. It affects our area. It affects Walnut Creek. It affects Concord. As an example, my son who bought a home in Concord, I think 2 years ago, there's over $150,000 in equity in 2 years in Concord. And so, yeah, it's tough. It's tough. And most people who get pre-approved and put an offer on the home, they don't get accepted their first offer. It is tough. And this is where the value of having a strong realtor really comes in. And so, listen, it's a tough time. There are a lot of people. There's a lot of competition. The best thing to do is get your get your ducks in order and be ready.
And a strong pre-approval letter too. Yeah, because the stronger it is, then the better it looks for the seller and for the listing agent.
And as a lender, what I always try to do is I always try to give a call to that listing agent, try to be preemptive, and let them know how strong the borrower is. So as an example, I took an application here in Hercules on October 31st on Halloween, and they were looking to sell their property in Hercules and move towards Walnut Creek. Well, they put an offer. As it turned out, they ended up going to Danville, which is an extremely hot area. I mean, everything out here is hot. And so they went to Danville, and here it is February 5th, and they just got their offer accepted. So they've been trying since Halloween, and they just were finally able to get an offer accepted after I don't know how many tries. And so it's really difficult, and you have to be prepared for that.
Yeah. And, I mean, it's definitely a tough market out there right now, and just the competition is. But I like that. A loan officer that contacts a listing agent and answers questions and explains how great the buyer is. I mean, I think that's a huge deal.
Yeah, well, it's listen,
because you're literally putting your reputation on the line,
and we all have the same interest. We all have our client's interest, and so we want them to get into the home. And so, realizing that there's so much competition, we try to do whatever it is that we can to differentiate ourselves from every other lender out there.
Yeah, it's going to be interesting to see what happens in Silicon Valley in the next few years, because Redfin CEO, he came out and he predicted that there's going to be a huge change in Silicon Valley and tech companies start moving out. And that's because you have a lot of different other metropolitan areas that are now really gearing up for the tech industries and really providing incentives, to get these tech companies to move to their state or their area and, boost their market. So it's going to be very interesting. If he's right, that's going to be interesting to see how it affects the entire Bay Area and that correction. Yeah. Because Silicon Valley right now, like you said, is just driving a lot of the home values when you have, a Google intern making $70,000, right?
Yeah. Well, listen, if I was a CEO, I would definitely consider. I mean, first of all, being in San Francisco or in Silicon Valley is, you're just at the center of everything. However, there's a cost involved, and that cost is, well, can my employees afford a house here? If they can't afford a house here, where do they buy? Are they happy employees commuting 60 miles into the Silicon Valley, which is a hellacious commute? And so, listen, it does make sense for someone to, consider Texas or some other, area where taxes aren't quite so high. I totally get that.
Yeah.
But at the same time, there's so many people. California has so much to offer, and there's so many people who want to come here. And the beauty aside, it's a great place to be.
Yeah, Facebook did a study within their own company, and they saw that most of their employees were commuting anywhere from 30 minutes up to 2.5 hours every single day one way just to get to their headquarters to work. So they decided to start offering stipends. This was several years ago, and they would offer anywhere from $1,000 to $3,500 monthly rent stipend or housing payment stipend. And so you saw rent prices just skyrocket because then they started doing that. Then you had Google and Apple and all these big companies start offering stipends, and then you end up with a 2-bedroom house renting for $8,000 or $9,000 per month, right?
Yeah.
And then Google, their engineers, most of their engineers don't even live in the Bay Area. They're completely remote engineers. So it was very interesting for him to say, yeah, these big companies are going to really start looking at different areas now because they can get cheaper real estate. They can reduce operational costs, cut back on all those stipends, and still have remote employees like they do now anyway.
I'll give you a perfect example. So I have a longtime friend and client, and they live in Menlo Park. And when they bought their house in Menlo Park, it was at the very edge of a kind of a sketchy area. It was in Menlo Park in Palo Alto, but at that time, there was a kind of a rough, sketchy area right off University Avenue back in the 90s. Well, with the tech boom and that sketchy area is now gone. So this house that they have, and it's a nice house. Don't get me wrong, but it's a house. And when we did their last refinance, it appraised at $2.6 million. It's just a house. Now it's $2.6 million. It's because it's within a mile of Facebook. And so you're absolutely right. How can anyone who doesn't own a home there afford to buy there unless they're being paid a great deal of money by these companies, by Apple, by Facebook, by Amazon, by any of those companies?
So, want to get your opinion on the mortgage industry. You've been in it since the 90s. You've seen, I'm sure, a few cycles. The Great Recession, was that the biggest, toughest cycle that you saw?
Oh, without a doubt. It was humbling. It was very humbling. And so I believe, and of course I'm hopeful, that is a once in a lifetime event. And it was tragic for many, many, many people, and certainly changed my life as well. But listen, it happened, and there was a reason why it happened, and there were certain corrections that had to happen. And so, we've determined that, hey, if you're going to lend people money, they should have the ability to repay that money.
Yeah.
And that wasn't a criteria before. And so that's important. As people now who get loans, they must have the ability to repay. And that's one of the lessons that we learned is you must have the ability to repay a loan, or else you're not going to get a loan.
Yeah, when I talk to some new buyers these days, it's funny because there's some buyers that are so young, they don't remember, they were just in school, and it's like, okay, my parents went through that. I have no idea, right? But when I tell them that there were people that could go out, and there was a journalist who went out and got a loan under his dog's name. And his dog was pre-approved to buy a house. I mean, that's how much, it was basically free money back then. I mean, if you had a pulse, and it doesn't matter if it was a human pulse. If there was a pulse, they gave you a loan. I mean, it was just ridiculous. And then the way they packaged these loans and just hid like how terrible of a investment package it was, that whole collapse just took everyone down.
Yeah. And it was one of those things too. So I remember my mindset, and of course I had the wrong mindset, and my mindset was that, boy, here in California, and especially kind of in the Silicon Valley, and I lived on the peninsula for a while, that we were insulated from that. That there could be some ups and downs, there could be some corrections, but nothing dramatic because our economy is just too strong. Well, I was wrong, and I think a lot of other people were wrong as well, and it was devastating what happened. And so, the government came in and they did put a lot of restrictions on lending. It's so much tougher now, so much tougher. If you've been in the business for a while, then it's so much tougher now than it ever has been. And the just restrictions and the regulations and disclosures it's overwhelming.
Yeah, and I think when they started adding in all these different regulations, especially the Dodd-Frank Act, I remember when my team and we were selling foreclosures, and then that kicked in, and all the restrictions that started to come down the pipeline, I was like, oh my God, this is like serious restrictions here. And I believe till this day, they haven't even implemented everything in the Dodd-Frank Act because it's just too much. Now they're looking at, okay, well, what can we, get rid of? And now they're looking at the opposite way. But I think for the most part, it was really good to go from one extreme to the other, because now we're at a point where we can say, okay, well, we don't need to be this extreme, but we also need to watch out for what happened in 2007 and 2008.
Well, no, I absolutely agree. And it was, the pendulum did swing in such a far direction. And like I said, it was humbling for a lot of people who were in the business. But it was necessary. It was a necessary move. And you're right, now, a few years afterwards, we're kind of hoping that the pendulum will start coming back towards center where it really should be.
Okay. Well, thank you for being on the podcast. If someone wants to do business with you, what's the best way to contact you?
Well, we have a website, or they can email me. My email address, harold.bauer@caliberhomeloans.com. And I'm not actually sure of my website address. I'm sorry.
Well, it's right on if they just send you an email, your little link's right there.
And then when's the next seminar you're holding?
February 21st in Walnut Creek. It is a home buying seminar, and it's at noon, so we will provide a great lunch. And so here's the thing about the seminar is what most people don't know, and I know we're towards the end of this, I don't want to go into this too deeply, is if you're paying rent right now, there's a good chance you could afford to buy. And so the struggle that most people have when they're trying to buy a home is they don't have the money for the down payment, and that's where having a good lending professional will help. And so what my seminar will be focused on is the down payment assistance that's available to anyone, low credit score, low income. These programs are available to anyone, and most people don't know about them. And so essentially, there are programs out there that will come up with a down payment for you if you want to buy a home. And so really the only thing that you have to do is then make the mortgage payment. And so that's really what our emphasis will be on, is these down payment assistance, how we can get you into a house, and how you don't have to save up for 10 years to come up with 20% for a down payment.
And what's the best way to sign up for the seminar? Because I imagine there's going to be a few people interested in down payment assistance programs.
There are, thank you. So it's reach out to me, harold.bauer@caliberhomeloans.com, or they could always reach out to me via phone, 925-548-2293.
Perfect. And we'll go ahead and link up everything in the descriptions. And so thank you again for being on the podcast.
Thank you. It's my pleasure.
Thank you so much for listening to the podcast. Thank you to our producer, Sam Lubman. Please subscribe, like, comment, and share the podcast. Remember, you can listen to the podcast on iTunes, Podbean, iHeartRadio, Google Play, SoundCloud, and anywhere else you listen to podcasts. For more information on my business as a property manager and real estate team, go visit my website at markguzman.com. I really want to thank all of you for listening. It means the world to me, and I hope today's episode provides you value in your day-to-day life. I created this podcast to help showcase the many great people that live in this world and help share some knowledge that I've learned along the way in life. Again, thank you for listening. Check out our sponsors, and I'll catch you on the next episode.